Have you ever made an investment mistake that cost you money? Maybe you bought a stock at the wrong time, held onto a losing position for too long, or ignored an opportunity that turned into a massive success. What if I told you that even Warren Buffett, the greatest investor of our time, has made huge investing mistakes? And not just small ones. Some of these errors have cost him billions. But here's the key. He learned from them and turned those lessons into even greater wealth. In this video, we're breaking down Buffett's biggest investment blunders, what went wrong, and, most importantly, how you can avoid making the same costly errors. Because if even Warren Buffett can slip up, there are definitely lessons we all need to learn. Stick around, because by the end of this video, you'll have insider knowledge on how to make smarter investment decisions, avoid common pitfalls, and think like Buffett himself. Let's dive in. One of Buffett's biggest mistakes was waiting too long to invest in game-changing companies like Google and Amazon. Yes, Warren Buffett, the master of long-term investing, admitted that he completely missed out on these opportunities because he didn't fully understand their business models at the time. Google, for example, was making billions from search ads, but Buffett and his right-hand man Charlie Munger didn't dive deep enough into the potential of digital advertising. The result? A missed opportunity worth hundreds of billions of dollars. Now, think about this for a second. Have you ever hesitated to invest in a stock because you didn't fully understand it? Maybe you saw Tesla early on but thought, nah, it's overhyped. Or maybe you looked at Bitcoin in 2013 and thought, this will never take off. Buffett's mistake here is one that many investors make. Ignoring new industries because they seem unfamiliar or because they don't fit into traditional models. The lesson: don't dismiss something just because it's new. Do your research, understand the fundamentals, and be open to opportunities that could reshape the future. But missing out on a good investment is one thing. Investing in a bad one is even worse. And Buffett learned that the hard way with Berkshire Hathaway's original textile business. Now, this is a perfect example of why buying a cheap stock doesn't always mean you got a bargain. Buffett originally bought Berkshire Hathaway thinking he was getting a great deal on an undervalued company. But what he didn't realize at the time was that the textile industry was dying, and no amount of good management could save it. Instead of cutting his losses early, he kept holding on, hoping the business would recover. Spoiler alert, it didn't. Buffett later admitted that buying Berkshire Hathaway's textile business was a huge mistake, one that cost him hundreds of millions in opportunity costs. So what's the lesson here? Don't buy a stock just because it's cheap. If the business fundamentals are weak, a low price doesn't mean it's a good deal. You wouldn't buy a broken car just because it's on sale, right? The same logic applies to investing. Focus on quality businesses, not just low prices. Now, here's another classic Buffett mistake that almost every investor can relate to: getting emotionally attached to a stock. And for him, that stock was US Air. Buffett initially invested in the airline, thinking it was a solid bet. But when the industry took a downturn, instead of cutting his losses, he held on for way too long, hoping for a turnaround. The problem: airlines are notoriously bad businesses. They have high costs, low profit margins, and are heavily dependent on unpredictable factors like fuel prices and government regulations. Buffett eventually got out, but not before learning a painful lesson. Never get emotionally attached to an investment. Just because you once believed in a company doesn't mean you should hold it forever. Ask yourself, if I didn't already own this stock, would I still buy it today? If the answer is no, it might be time to rethink your position. Speaking of mistakes, let's talk about one of Buffett's biggest blind spots: not diversifying early enough. For years, Buffett focused only on traditional industries, things like insurance, banking, and consumer goods. It wasn't until much later that he started seriously investing in tech, and by then, he had already missed some of the biggest gains. Now, don't get me wrong, Buffett's strategy of investing in what he understands is smart. But at the same time, the market evolves. Industries change, new opportunities emerge, and investors who fail to adapt get left behind. The lesson here: even if you have a core investment philosophy, don't be afraid to evolve. Diversifying across different industries and sectors reduces risk and increases your chances of long-term success. But perhaps one of Buffett's most painful lessons came from trusting the wrong management teams. A perfect example: Tesco, the UK-based grocery chain. Buffett saw an opportunity and invested heavily, believing in the company's brand and market dominance. But what he didn't realize was that Tesco's management was making serious accounting errors, leading to financial misreporting and a collapse in stock value. Buffett failed to exit early, and by the time he finally sold, he had lost hundreds of millions. The takeaway: good management is everything. You can have a great company on paper, but if the leadership is corrupt, incompetent, or reckless, your investment is at risk. Always keep an eye on who's running the business and whether they are delivering real, transparent results. So, what can we learn from all of this? Even the world's most successful investor makes mistakes, but the difference is, he learns from them. Buffett's approach isn't about avoiding mistakes altogether. It's about minimizing losses, adapting to changes, and focusing on long-term growth. Now, I want to hear from you. What's the biggest investing mistake you've ever made? Have you ever held onto a losing stock for too long? Missed a golden opportunity? Let me know in the comments. And if you want to keep improving as an investor, hit that subscribe button, because we've got a lot more coming your way. Until next time, invest wisely. See you.